I think if you're making more than $300,000 a year, you should just keep the main thing. Take capital and partner it with someone else, and you invest it into any kind of passive investment strategy. The way I look at it, every time you invest into a passive investment strategy, you're buying future days off. The idea is that you buy enough future days off that eventually you don't have to go back to work, or you can start working part-time at the clinic, or you can start dialing back on your procedure load or whatever it may be. Get to the point where the numbers make the decision for you.
Folks, your exciting new medical career, it's just been hit with a serious illness or injury that stops you from earning a paycheck just when you need it most. Check out what Jamie Fleischner of Set for Life Insurance said back on episode 176 about having disability insurance early in your career.
The real reason to get it early on is really twofold. One is to protect your insurability. So if you are healthy and you can obtain the coverage, you also pre-approve yourself to be able to buy more in the future. So down the road, as your income does increase, you don't have to answer additional medical questions. All you have to do is show that your income is increased and you can buy more benefits at that time. No medical questions asked.
Protect your income, secure your future. Check out setforlifeinsurance.com. All right, everyone, we have got Clint Harris at Nomad Capital. It says GP at Nomad Capital. What does GP mean at Nomad Capital?
I'm a general partner. So I started off with my partners just as a joint venture. And then basically, I'm a very small percentage of the ownership. I've got two partners that are father and son team that founded the company and invited me to join in as a general partner. And I handle investor partner education and capital raising.
What does Nomad Capital do? Talk to us about that.
So we're a self-storage syndication. First of all, syndication is just, every time you drive by a hotel or a multifamily
we hear that a lot. Syndication.
Yeah.
What is a syndication? Tell us that.
It's a situation where a group of investors pool their money together to take on a real estate project larger than what any one individual could likely do on their own. So anytime you drive by a big apartment complex or a big hotel, very rarely is that one owner. That's a group of investors that have pooled their money together to take on a larger project. And you have general partners that are the ones doing the day-to-day operation. And then you have limited partners, which are people that are contributing their capital to be a part of the project. So, we all know that to have success in business or especially in real estate, it takes three things. It's time, it's experience, and money. And this is a situation through syndication where people that may have money, have capital, but don't have time or don't have experience can partner money with people that do have time and experience to take on bigger projects. So we're a syndication and we specifically focus on self-storage.
I'll be honest with you, like several years ago, when I would see like a big hotel, when I'd see, whatever building, and if it's for sale or if it's for rent, I would see like this name, right? Like this company name. I always assumed that it was just a large company built with a whole bunch of, or being run by a whole bunch of MBAs or whatever, some type of real estate company, but I never quite looked at it like, for the most part, these may be syndications brought up by different investors and so forth. It wasn't until like I got into, I'd say like 4 or 5 years into practicing, and I started realizing that doctors were getting into, creating their own like surgical short stay suites and so forth. And they would get multiple investors to, buy into these things. And then eventually syndication came down the line as we started doing more and more of this podcasting. So syndication basically sounds like if you ain't got enough to buy a large property, you get a whole bunch of different investors and then you kind of figure out the rest later on. But you just have multiple people who are purchasing and have multiple, like, what's the best way I can say it? They have different layers of skin basically involved in owning and you said it the best, but basically multiple people taking care of a property.
Yeah, you've got it. You can have an individual project like one hotel, and we're going to go raise $10 million from a group of investors, and some people are putting in 50 and some people are putting in 250 or whatever, and we're partnered with someone that takes down that project and manages it, the day-to-day, the value add, increasing the value of the property by increasing the net operating income. And at some point, traditionally, there's an exit, right? You sell the asset for everybody to get a payday. We're a self-storage syndication, and the way that we do it that's a little bit different we don't need to go down the rabbit hole of our strategy too much, but instead of buying self-storage or building self-storage, we specifically focus on buying old big box retail buildings like Kmart's grocery stores and warehouses. Big box retail has basically destroyed that space has gone away because of Amazon and Walmart. Like it's basically just been wiped away. But at one point there was 1,200 Kmart's across the country.
Right.
We've all seen these buildings
It's
just
like
sitting there.
dinosaurs now and stuff.
Exactly. So we buy those old big box retail buildings that nobody else wants. My partners are the GC. We do the construction and we convert them from old nasty buildings that nobody wants to Class A climate controlled self-storage facilities. So we raise money from groups of investors. We get the buildings for so cheap that traditionally, like if you and I wanted to go build a self-storage facility, it's going to cost us about $120 a square foot plus the cost of the land. With all of our last conversions, with the land, the parking lot, the conversion, and once it's turned into a Class A climate controlled self-storage facility, we're usually sitting around $63.50 a square, which means when we are hitting stabilization and we're usually buying a property for a couple million, we raise a couple million to do the construction. And then as a stabilized self-storage facility, it's usually worth 13 to 17 million. We're usually sitting around 30 to 35% loan to value, which means we can refinance, give everybody a great payday. When you get paid out by way of a refinance, that's not a capital gain because you don't sell anything. So there's no taxes. And then we can keep the asset and allow it to continue cash flowing moving forward. But
that sounds great, Clint. That sounds great, Clint. I don't know what the hell any of that stuff means. And probably the majority of docs who are listening don't know what the hell they look, we're going to be honest with you. I'll be honest with you. I'm a surgeon. I spend most of my time in the operating room. I get paid to operate. I got the loans to back it up. Yep. I spent 4 years in med school, 5 years in residency, another year in fellowship. And then I work and I take care of people and I understand that lingo. Everything that you just said, for the most part, I understand syndications, but I think the majority of people who hear what you say goes over their heads. So let's bring it down a little bit, right? Back to like first grade, second grade levels. Like, why should people be considering, why doctors specifically who make more money per hour doing their job, right? They spent so many years, like, talk to us about why we should consider real estate. Why should we consider like syndications? Because I'll be honest with you, there's a lot of noise out there, right? People are saying get into Bitcoin right now. Bitcoin is back, right? I don't know how long it's going to last, but Bitcoin is back. You got regular stocks, right? Then you got all these other type of pump and dump things that are going on just on another level. I'm not equating any of that stuff or even syndications to that, but there's a lot of noise. Yeah. Talk us through how to kind of wade through all of that to really understand real estate on a level of why doctors should really consider it when they make so much money doing what they do best. Yeah. Talk us through that.
So first of all, I had a 16-year career in medical sales, implanting pacemakers and defibrillators. So I've seen this world. I worked in the EP lab and cath lab and the OR. So I've seen that side of things a long time. I also know what it looks like being on call and working nights and weekends. And the last thing I want to do, especially to the white coat community, is my job is not to sell our deals or what we do to anybody. But what I think is really important for your community, and one of the reasons I think what you're doing here is valuable, is that these should all be tools that everybody has in their tool belt to figure out what they want their future to look like. And if you're a white coat physician, you're making a really good income. But at the end of the day, you're still trading time for money, right? You said it best. You're making a really, really high income. You're a surgeon, or if you're an interventionalist or cardiologist or electrophysiologist or orthopedics or whatever it may be, you're getting paid a really high amount for the time that you put into it. At the end of the day, you're still trading your time for money.
So that's missed funerals, that's missed weddings, that's time
Baseball
with kids.
Games, all of it, right? Uh-huh. So I think this comes down to what's a person's journey and what do they want for themselves? Because if you love what you're doing and you're certainly doing great things for your community and you're helping people in a very tangible and meaningful way, if you love that, then keep doing it. I think that if you ever think there's going to be a point in time with your life or if you're with your goals and what you have coming down the line, if there's ever going to be a time when you don't want to start trading time for money, the day that arrives is not the day that you need to start thinking ahead and planning for that. So there's a lot of different ways that you can build, maybe not an off-ramp, but just create some more options for yourself and put yourself in a situation where you have freedom of choice. Like we're all looking for, this is something that I think resonates with a lot of people in the white coat community, is that everybody's talking about financial freedom. The reality is I think that goal by itself is a little bit shallow if it doesn't come along with location and time independence. Because what most physicians have is they have At first they have debt, right? But eventually they start having money to spend. But a lot of times what they don't have is time and freedom of choice or freedom of location about how they want to spend that. I think if the overall goal is not just financial, but it's time and location independence, those three things together can create an independence of purpose, which I think is what people are really looking for. Now, the way that you do that, if that's something that you want, you have an unbelievable amount of options. You could do crypto, which is a little bit speculative. You can do real estate. You can do active real estate. I built a portfolio of 14 Airbnb properties at the beach, which eventually replaced my income with what I was doing with medical sales.
So active real estate would be the traditional form of you own a piece of property, you're the landlord, fixing toilets, getting the rent checks. That's what you mean by that?
Yeah, absolutely.
Okay.
And the good news about that is that most physicians have the liquidity to get into that space very easily.
Yeah,
Single family homes, small apartment complexes, and everything else. But like, you better price in to have somebody else manage it for you, because if you're a surgeon, we all can calculate what your worth is per hour.
Right.
So every time you are doing something to manage your property, instead of paying somebody whose time is worth a lot less than yours, you're kind of leaving some value out there. What the mistake that I made is that I built up 14 properties that did not allow me location independence, and I couldn't walk away. They're really busy during the summer. It's at the beach. It's busy on the weekends.
This is while you were as a medical sales, right?
That's right. Doing that on the side.
So you would do this on the side, and you build 14, or you were able to garner 14 properties on your own.
Yeah, they're multifamily properties, so the number's a little misleading, but it's 3 quadplexes and a duplex. It's 14 Airbnb units, but 4 buildings.
Got you.
So that velocity of multifamily helps out there. But that turned into a property management company that we opened up with some partners that manages another 85. So my wife quit her job in medical sales, all in on real estate.
But you're winning now. It sounds like you're winning. What's going on? Talk to us.
On paper, it looks right, doesn't it?
Yeah.
We get everything that we're looking for from the financial standpoint. What we did not get was the time and location independence. And my goal is to have a life where, I eventually wanted to make my way towards a lifestyle where if I did everything right, I've got young boys. I got a 4-year-old and an almost 1-year-old. If I did everything right, later on in life, they may not ever remember that I sold pacemakers, that I worked in the lab or anything like that, because we kind of successfully created an off-ramp. What I really did was I built a second job for myself, where I was still trading time for money, right? So the real question for me,
even though it was under your terms, you still wasn't. You just felt like a job.
It was a job, because I'm locked into one location, and I have to have my phone on me to answer messaging the same way that I did before. Now I'm just on call more, basically.
Okay.
So to me, the jump was, how do I get to a point where I'm not trading time for money at all? And the way that worked for me was to partner with someone else that had expertise. First of all, I went out and have found the oldest, most successful business and real estate people that I could find. And I said, what are those guys doing? The people that look like they're sitting around not doing anything, and they can go travel when they want, fishing when they want, whatever. And inevitably, it was 3 things. It was hard money lending and note lending. And I didn't have any money to lend anybody. And it was people that owned mobile home parks, which I had no business in that, no interest, or it was self-storage. So that's the direction that I went. But it doesn't really matter. It doesn't matter what you choose. I think the question is, how much time are you going to have to dedicate to it? And is there an off-ramp or a way for you to back out of that future on down the line?
So you think that for most doctors who are spending their time clinic, hospital, whatever it may be, doctoring, the active part can only get you so far. And you think that maybe passive investing, which we're talking about specifically like syndications, that might be worth more of their time, so to speak. You get more of a return on investment.
I think if you're making more than $300,000 a year, you should just keep the main thing, and then take capital and partner it with someone else in a strategy that you're interested in, and you can keep your finger on the pulse of what's happening. But it's better off, instead of you taking time to go actively do those things, you're going to have to get really good at it and take a long time to earn enough to replace the income that you currently have. So I think the better option is to just keep the main thing. And anytime you take money or capital and you invest it into any kind of passive investment strategy, and there's a lot of them out there. The way I look at it, every time you invest into a passive investment strategy, you're buying future days off. The idea is that you buy enough future days off that eventually you don't have to go back to work, or you can start working part-time at the clinic, or you can start doing, dialing back on your procedure load or whatever it may be. So, get to the point where the numbers make the decision for you.
No matter where you are in your career, you've seen patients your age or younger get seriously injured, have a long-term illness, or even have a mental health issue that affects their ability to work. Now, what if that was you? No, for real, what if that was you? Without disability insurance, how are you going to replace your paycheck? In episode 176, Jamie Fleischner of Set for Life Insurance explains why the best time to buy disability insurance is during your residency.
Most physicians acquire their disability policies during residency, and there's several reasons. First of all, when you're younger, you're able to obtain the insurance because they ask you a whole host of medical history. And so you usually don't get healthier over time. Usually you get less healthy over time. So when you're healthy, it's easier to acquire the coverage. Number two, it's also less expensive because it's based on your age and your health. You're not getting younger or healthier over time. So you're at the ideal time. The earlier you get it and the younger you are, the less expensive it's going to be.
So whether you're a resident or you're an attending, it's never too late to protect your income. Renee and I, we use Set for Life Insurance to find a disability policy that fit our needs and budget. So what are you waiting for? Check out setforlifeinsurance.com. Once again, that's setforlifeinsurance.com. So take us through that. Talk us through, like, we're first graders. How does that work, right? Because let's say, for example, I am a surgeon or I'm an ER doc and I own like multiple quads and I'm getting monthly checks, right? I understand that. That's in my bank account. I'm getting monthly checks. I use that to pay off the mortgage, whatever's left, and all the CapEx and all that stuff. I'm taking all that stuff, right? That's elementary. I get that. How does it work with a syndication? Like, I'm not getting anything on a monthly basis, right? How does that work? How does someone make that jump mentally wise to say, okay, well, maybe I shouldn't put my money in active, but I should consider a syndication. How do I get paid? How does that work for my taxes? Take us like specifically through those things.
So there's a lot of different options out there. And I think accessibility to operators and deals is better now than it ever has been. There's a lot of different online marketplaces where you can go to find out what's out there. But yeah, I think the number one thing is decide what you want. Do you want monthly cash flow? You can go invest in an apartment complex and you're just going to get monthly checks and a monthly newsletter. And that's it. And some of them may last 5 years. Some of them may last 7 years. Some of them is going to be an 18% annualized rate of return. Some of them it's going to be 22. Some of them are going to be development projects that take longer because you got to build something for the first couple of years and then fill it out. But yeah, you can get quarterly distributions. You can get monthly distributions. You're going to get a K1. You're going to get accelerated depreciation. A lot of physicians like to invest in properties that have larger depreciation because you're going to be able to get a K1 and offset some of your other income that you have coming in as well. So a lot of it depends on what your goals are and what you're trying to accomplish. But the way that it looks is you're going to look out across an RV park, a mobile home park, a self-storage facility, and an apartment complex. You're going to find an operator that you like and that you trust. You understand their business model and you look at it and eventually you say, yeah, this looks good. You review all the legal documents, an operating agreement, subscription booklet, private placement memorandum. You can invest either with cash or you can invest with a retirement account. And then when you say like, yeah, this all looks good, it's SEC regulated. And then you invest in the project. And then from then on, typically you're getting monthly newsletters. You have an investor portal that you can log in. You can track the progress of the property. You can see what's happening with the development. You can see where it is in lease up or lease increases. If it's an apartment complex or renovation or whatever, you're following along. You can be as involved as you want to. And then typically you're going to get either monthly or quarterly distributions. The life cycle that I see for most people is most people want to do exactly what you said. You want to buy a bunch of small quadplexes. You want to get those monthly checks. You're going to manage it. You're going to get the taxes, the maintenance bills, all that. And you're looking at your return on investment, or you're looking at your cash on cash return. We put this much cash out. How long is it going to take me back to get that much cash, right? What typically happens in the life cycle is eventually people realize that they still have to manage that or have to manage the manager of that. And a lot of times, instead of having, in terms of scale, to hit the level that it needs to affect your life, the ability that you have to spend time with your kids, the amount of time you have to spend with your spouse, the amount of time that you don't have to spend in clinic or in the OR to scale to a point that it starts to affect your life in a meaningful way. You have to grow so big that it makes more sense maybe to get into one apartment building, because after you hit about 60 units, you can have an on-site manager and the load becomes so much easier than having a bunch of smaller properties. Eventually that person that moves into that larger property that finally gets to a level that it starts affecting their life in a meaningful way in terms of the cash flow usually gets to the point where they say, they were looking at the return on investment. Then they were looking at the cash on cash return. Then they're looking at the return on equity. That person eventually usually gets to the point, says, what's my return on time? The amount of time that I have to spend thinking about this real estate project and managing it or managing the manager, what's the return I can get on time? And a lot of times, if you go out and you're an active investor, you can probably beat the returns you're going to get through a syndication. You can go out and you can flip houses.
This is what I'm looking for.
Apartments.
Okay.
You can do that. You can go make 30, 35, 40%, right? You're going to be active. You're going to be trading time for money, and you're going to be investing some nights, some weekends, whatever it may be, or have a partner.
You're going to be asking people to cover for you a lot so that you can manage this. Right. It's going to be interruptive to your main schedule, probably.
Right. And so what's worth more, doing that or keeping the main thing? Most people, especially in the white coat community, eventually get to the point where they say, you know what? I would rather make, instead of making 30 or 35% return on investment per year, I would rather make 20 and think about this for 1 hour every quarter when I get my quarterly distribution check, or 1 hour every month when I get the monthly distribution check, however that operation is set up.
So where are these syndications at? Like even before we get to that, like how do you, because you mentioned operators, so I'm assuming that's the person who's going to be putting this whole syndication deal together. Am I talking correct? Yep. How do you find this person, or how do you find like an aggregate of these people? How do you vet them the right way? How do you know what a good deal is versus what is a bad deal?
Yeah, that's a great question. A lot of times the deal could be dependent on what your goals are. So first of all, there's that. But outside of that, there's communities where you can find people like leftfieldinvestors.com is a website. It's a community of about 1,200.
Say that again?
Leftfieldinvestors.com. I'm not affiliated at all. It was a small community that is now I think they're probably up to 2,500 members. They had about 1,200 a little over a year ago when I connected with them. It's about 2,500 members that are specifically people, mostly highly successful people, that are looking for opportunities and different operators to invest with. And so the beauty of that is you have a bunch of operators in there sharing their deals and what they do and what their strategy is. And you have 2,500 people picking it apart and talking about it and having community about that. They have a website. They also have a social media site. Yep. And then they also have, you click on community up there. There's a whole social platform. They have podcasts, which are great for education. And they also walk through different investors. Also, a conference that I think is groundbreaking for me is Joe Fairless has the Best Ever Real Estate Podcast. It's the longest running daily real estate podcast ever out there. He's got a community. There's a conference in Salt Lake City this year called the Best Ever Conference. There's a lot of different resources out there. If you just look at what you're talking about are alternative investment strategies. In the alternative investment space is where usually something in real estate, but it can be ATMs, RV parks. It could be hotels converted to
Clint,
condos.
Hold on a second. So is ATM still a big thing? Because I thought ATMs were I remember 10 years ago, ATMs were like a big deal. But is that still the case, or? It's
not a big deal, but there's still people doing it. But you want to invest in, you can invest in a vineyard. You can invest in grass-fed beef. You can invest in ATMs. Like there's a lot of different operators out there. We live in a pretty small space. Like I like self-storage. There's nothing inherently sexy about self-storage. You're renting someone a box of air, but it's very predictable as to what the demand is going to be. So, but you figure out what you want. Go for it.
I heard you on another podcast talking about that. Like, why is self-storage such a big deal? Because not even from the return standpoint, but from you were talking about like the mindset of people who they rent a lot. And then because they have to get smaller rentals, that's what they can afford. They have to get another. I'll let you speak, but talk to us about it, because that's really fascinating, the mindset, how that works,
Well,
almost like Freakonomics.
my biggest concern when I invested as a joint venture partner with storage at first was like, what do you think of when you think of storage? Like, I think of baby boomers and Christmas decorations and old china cabinets and stuff that's going away in storage that nobody is ever going to see or touch again.
Right.
And so I was like, okay, well, as that population segment dies off, what's happening to storage? Is this an asset class that's going away? And the unfortunate reality is that especially young people in our country can no longer buy houses the way they once did. They're renting. When you buy a house, you have an attic, you got a basement, you got a garage. But when you rent, you're renting based upon the square footage that you're getting, right? And so what we're seeing, there's a lot of growth and people getting pushed out of these urban markets into these smaller secondary and tertiary markets across, especially the Southeast area. North Carolina, Eastern North Carolina is having explosive growth. A lot of people became location independent because of COVID, and people are getting pushed out into these markets that traditionally are underserved for storage. And you're seeing apartment complexes and housing blow up all over the place. Well, when those people are renting instead of buying, instead of renting a 2-bedroom condo for say $1,800 a month, they're going to rent a 1-bedroom condo for $1,300 a month and then get a storage unit for $150 or $200 a month, because they're using it as an extension of the garage, an extension of the closet. So they still have the way that the younger generation is using storage is wildly different than before. Previously, the baby boomers are going in there once or twice a year. Millennials are in the property usually 2 to 3 times a month. So what matters to them is, first of all, proximity, high residential density in a 1, 3, 5, and 7 mile radius. But it has to be several things. It has to be safe, secure, well lit, easy access, and it has to be climate controlled, because they're putting clothes in there and mountain bikes and kayaks, and they need to be able to get in there at 6 a.m. on a Saturday morning and grab their snow bibs and their board and get out of town and get to the mountains. They're in and out of there differently because they can't afford to own the space that you and I probably grew up in. And so because of that demographic change, like, the millennials now make up the largest population segment that we have. It's 34% of the population, but they use up 38% of the storage. So I think just keeping your finger on the pulse of what's happening with the country, bad fiscal policy is creating life changes for younger people. And because of that, they're living differently. And if you look at storage, that's an extension of the closet or the garage, and it's not discretionary spending for them. This is a necessary spending pattern that they have.
So, for example, if someone's listening to this right now, they're like, listen, like, that sounds great. That's amazing. So the self-storage part would be that whole entity, that building self-storage. One person wouldn't necessarily own that. That'd be an example of a syndication, correct? Where you get several investors and go in there. Is that something that, like, Nomad Capital that you guys, is that like properties that you guys have, like, within your, I don't know what you guys call it, in your role or something like that? Or
Yeah. So last year we did 2 Kmart's, 3 warehouses, and a grocery store that we did as individual deals. So we had individual buildings that we would get, 15 to 20 investors together. We would raise capital. We go buy the building, we do the conversion, and we turn an old Piggly Wiggly grocery store into a Class A climate controlled self-storage facility. Now we started a fund. And so this year we have a fund going on where we pool money together in a fund, and that fund is buying 5 self-storage facilities across the Southeast. So we've already closed on 2 of them and are doing the conversions, and we got 3 more in the pipeline. So one investment gives someone ownership across 5 self-storage facilities spread across the Southeast, different operators on a local level, different market drivers. So that's the idea. Syndication offers you to take on projects bigger than you could do on your own. And it allows you sometimes within one investment to create diversification in your portfolio. But I would be honest with you, that may not be enough return for people if it doesn't hit their goals, and you should go be active. If keeping the main thing is more important to you and not sacrificing your time, I think that's the place where a passive investment strategy can make sense.
Okay, so let's dive into that as our last point then. So someone who's listening right now, maybe they're early in their career, they're like, listen, Doc, I want to start building that off-ramp. Right? Maybe not now, but maybe in 15, 20 years, right? It sounds like passive investing, like maybe getting into a syndication, might be down their alley because they're not quite ready to give up their practice yet. They're building their nest egg, they're building themselves, naming a community with their clinical practice. And then eventually, maybe in 15 years, they buy themselves that off-ramp and they're gone. But for those right now who are thinking about, look, like, I need something right now, I need a higher rate of investment. You're saying more of a hybrid approach might be the answer?
Yeah, I would say the number one thing is don't get lost on the deal. Don't find the deal that you like and then change your goals to match that. I would say talk to your spouse and have some clearly defined goals as to what you're trying to accomplish with your life and what you want to do. And don't sacrifice being happy now and enjoying your family and your travel and your time to put that off. Don't sacrifice too much right up front. But I would say, yeah, you can have a hybrid approach and you can invest basically with a fund model in mind. Like, look, first of all, you probably want to pay off your medical school debt first, right? Or
Hell
look
yeah,
for
absolutely.
areas. Yeah, get rid of that first and foremost. Like live, hopefully below your means. I think that a lot of physicians coming out of med school, you guys are one of the few people left that have the ability to save your way to retirement if you want to. For me and like my parents' generation, my grandparents' generation could save their way to retirement. I think for most people my age, I'm 41, for most people that's been taken away from us. Physicians are one of the people that you still can save your way to retirement. So if you live within your means and you want to save your way there, you can do that. If you have bigger goals for your life than that, you're probably going to need to play offense instead of just defense. And that means investing in some capacity. Number one, invest in yourself and pay off your medical school debt and specialize or do whatever you want to do. I would say this, if you think a passive investment strategy is part of where you want to end up in terms of just one of the tools in your tool belt, you can look at all kind of different offerings, all kind of different return platforms, but also remember most of them don't start paying off in a meaningful way right away. It's going to take you 3, 4, 5 years before the first one. Hopefully do the best you can to double your money in 5 years or less.
This
But
is
you don't,
active, right?
this is as a passive investment strategy.
Passive. Okay.
Yeah.
So
So
syndications and so forth.
yeah, something like that. Like I said, there's a lot of different structures, but don't wait until, a year or two and expect to replace your income. It takes a little while to get going. So you kind of want to, you don't want to wait till it starts raining to start building Noah's Ark. You know what I mean? You want to kind of think ahead a little bit.
So, okay, I know you said distributions can occur on a yearly basis, right? And then there's also benefits from a K-1 standpoint with your taxes and so forth, the depreciation and so forth. Like what is the end goal then with a specific syndication? Is it is it the yearly distributions, or is it with the thought process of eventually this property is going to get sold and then there's going to be a larger payout at the end? Talk us through that part, because I think that could be a little bit confusing for people also.
That's more typical, right? So the typical syndication is going to look like you're going to buy a B or a C class apartment complex. You're going to go in, you're going to make it nice. You're going to put granite countertops, stainless steel. You're going to increase the rents and the value of the property because the net operating income goes up, basically just meaning the rent goes up, right? When the rent goes up, the value of the whole thing is going to go up by 30, 35%. You're going to hold it for 3, 4, 5 years. Everybody's going to get a little bit of the monthly rent, and then you sell it. And when you sell it, everybody gets their money back plus another big chunk on top. My only problem with that is that at the end of the day, you're still trading time for money. Like if you zoom out, you're a glorified house flipper, right? You're buying something, you're fixing it up, and you're selling it for everybody to get a payday. That's great, but you got to keep working to keep getting paid. I am interested in investment strategies where if you're house flipping, you're wholesaling, anything like that, you're a real estate agent, the day you stop working is the day you stop getting paid. Same thing if you're a physician. The day you stop working is the day you stop getting paid, because one way or another, you're trading time for money. The reason I like our strategy, but there's a lot of other strategies like it, and I'm not saying ours is that unique, because we're building these properties out for so cheap. What we typically do is at 4 or 5 years in, around the 5-year mark, there's going to be a refinance. You get all of your original cash back plus another chunk on top. Plus, you've been making quarterly cash from the cash flow coming out of the property. So do the best we can to double our investors' money in 5 years or less. But after that, you move on to something else. Go find another project. But you still own your same percentage of equity in that project. And we're going to hold it in the long term. We're sitting around 160 million in assets under management right now. We have a 5-year goal of 500 million and a 10-year goal of $1 billion. The reason.
Okay, so when you refinance and you get the large cash back, you still own the property. It's just under different terms.
Whatever percentage of equity that you owned on the project, you still own it. Say you own, I'm making up a number here. Let's say you own 5% of a building with a group of other people. Well, when you refinance, let's say you put $100,000 in. So when we refinance, you get your $100,000 back plus another 70 or so on top. Plus you've been getting the cash flow up until that point. So hopefully between all those things, you double your money in 5 years or less, but then you still own 5% of that project. You're exactly right. We reset the debt basis because we refinance, but say we're going to own it for another 20 years. You're continuing to get paid out with every cash distribution on that. And let's say you take that money and you go move on to another one and then another one. That's the idea, is that you're basically, you can build up your own pension by buying ownership in projects that we continue to hold long term.
I got it.
To me, that's the benefit over if we're buying something, we're fixing it up and then selling it. That's great, but you're going to get paid once. And so are the operators, right? The idea is the reason we're called Nomad Capital is because a nomad is somebody that goes where they want, when they want, and does what they want. You can't do that by trading time for money and getting paid once. You have to own a portfolio of properties that continues to cash flow moving forward. And so for us, we want everybody to get those good short-term returns. But the important thing is that we want that long-term cash flow, and we're building a tribe of real estate nomads and everybody can stay in. And again, I don't think there's anything like what we're doing is special in the self-storage space, but we're not the only ones doing it. I think the important thing is this is an example of what I mean of like deciding what's important to you. You know, do you have a long-term vision or a midterm vision or a 5-year vision? Let that determine who's the best operator for you, what the best strategy is. But the best thing is figure out what those goals are for you. Are you trying to replace your income because you don't like clinic and you don't like going into the lab or surgery or whatever you're doing? Like, you can clearly define that and hopefully work backwards to something where you have a little bit more independence of purpose about what you want the rest of your life to look like.
There it is, guys. So Clint Harris with Nomad Capital. Listen, if people want to further this conversation with you, and find out like what you guys have to offer, how do they get in contact with you guys? How do they learn more about Nomad Capital?
The best way is you can email me directly, clint@nomadcapital.us, or just go to our website, nomadcapital.us, and schedule a call. I talk to investors and physicians all day, every day, and I love it. So happy to reach out.
There it is, guys. So Clint Harris, thank you very much for your time, for teaching us basically a different spin on syndications. We've had people come on before and talk to us about syndications, but this is another different way of looking at it. Me and Renee, guys, just for transparency's sake, we are involved in a syndication deal right now. It's the first one, the traditional sense, where we've put in a certain amount of money, and then after a certain amount of years of them improving the property, they'll sell it, and then we'll kind of get our large distribution from that. But this is something that I didn't know was out there, so it's something to consider. So make sure you guys contact Clint as well as the team at Nomad Capital if you guys want to learn more about this. Once again, Clint, thank you very much for your time, man. I appreciate it.
Thanks, Dr. Nee. Appreciate you having me.